1 Minute with Mitch.
Hi everybody, it's time for a Minute with Mitch. There is a lot of economic data out and lots of information. Today's information actually is coming from Investors Business Daily. That's my source for this great information. We've seen the economy starting to finally crack a little. We're seeing the jobless claims go up a little. We are not seeing people move around like they did over the last few years, where they were going to leave a job for a $2,000 raise. We're seeing that slow down. There's also been reports that job postings have been a lot less and a lot lower. But we have seen some very good statistics come out recently, and it's kind of counterintuitive, where we're hoping for things to come out bad so the Fed can lower interest rates. You know, they took 16 interest rate hikes, and they went from 0 to a target of 5.25 to about 5.5. The housing market is starting to see some slowdowns in many areas. Prices are starting to dip a little in many areas throughout the country as well. Again, when interest rates went from anywhere from 2.7 up to about 7% now for a 30-year fixed mortgage, that significantly raises people's monthly mortgages. So that is starting to show some weakness as well. Some numbers to look at. Jobless rates rose about 3,000 jobs to about 236,000 job claims. That's the most since last September. The ranks of unemployed workers continuing to claim benefits unable to find work rose by 18,000 to 1.839 million people. This was as of the last week of June 30th, 2024, according to Investment Business Daily. However, Wednesday, first quarter GDP did go up a little. It went up, it was revised from 1.3 to 1.4. Not that big a deal. That was according to the Commerce Department. And the big issue, though, is consumer expenditures rose 1.5%. However, that was revised down from 2% last quarter. So when those numbers go down, that's showing some cracks in the economy, which again, what they are hoping for by raising rates 16 times over the last year and a half. The deficit, the trade deficit, went from 98 billion to 100 billion, and exports dropped about 2.7%. Part of the reason is the dollar is getting very strong. So with the dollar getting strong, it's costing the world more money to buy our goods because we have a very strong dollar right now. After jobless claims and other data, markets were pricing in a 65% odds rate. The rate will be cut by the Fed in the September 18th policy meeting, probably 0.25%. 65%, it actually has gone up from about a 62% raise. So again, lots of data coming in. Things look like they're finally slowing. We may finally get that rate cut that everybody has been talking about. If you remember, at the end of December, beginning of January, everybody factored in 6 rate cuts throughout the year. Here we sit, July 2nd, 2024, we've had 0. But we're starting to see some cracks, and most people, 65% at least, economists, believe we'll see some type of rate cut at the September 18th Fed policy. We'll see what happens. We'll see where that goes. We'll continue to monitor it. We had an outstanding first 6 months of the year. S&P up almost 15%. Again, it's still being mainly driven by the Magnificent Seven, as evidenced by the Dow, which is only 30 blue chip stocks. For the first 6 months was only up about 3.9%, according to Yahoo Finance. So you can see it's not as broad-based as we would like it. It is better than it was last year, however. So the good news is we're starting to see a little more broadening, but the Dow was only up about 3.9% for the first 6 months of the year. Everything is still being led by your big seven tech stocks. So we're looking going forward at tech and consumer staples. More to follow on the next Minute with Mitch. Thank you.
1 Minute with Mitch.